Good afternoon and welcome back to Moneycontrol live stream. You're watching Closing Bell. I'm Santosh Nair.
And I'm Yatin Mota.
Indices closed on a bearish note today. Both Sensex and Nifty saw sluggish trade. However, midcap stocks continued to be in demand. They fared slightly better than their frontline counterparts. In sectoral trends, banking stocks and IT stocks continued to be under pressure, whereas IT and pharma shares continued their winning streak for the second consecutive day. Among prominent gainers in the Nifty, the list was largely dominated by pharma shares. You had pharma and healthcare, in fact. Apollo Hospital, Divi's Lab, Dr. Reddy and Cipla were among the big gainers. The other non-pharma stock which posted handsome gains today was BPCL, which was up close to about 2%. And as for the prominent losers of the day, it was pretty much a mixed bag, but largely dominated by banking stocks. You had Hero MotoCorp, Kotak Bank, IndusInd Bank were among the prominent losers of the day.
Absolutely, and today, probably it was a day of consolidation. Overall, if you look at the markets, they were consolidating, and advance decline ratio, Santo, after many days, it has moved towards the declines, wherein the declines were almost 12 and the advances were 8. So, yes, the advance decline ratio has moved pretty weak, largely due to selling in PSU banking name as well as some frontline counters. However, the mid-cap indices continue to gain almost 0.2% higher for the mid-cap and small-cap index.
Not much of an impact, Yatin, of the dovish pause paused by the US Federal Reserve. Earlier market was expecting that probably there could be a rate cut by the end of 2023, and now it seems like there will be at least a half a percentage hike, which is something that has come as a rather a nasty surprise for the market. Still, yes. All things considered, Indian markets seem to have taken the news in its stride. So, yes. Does it mean, Yatin, that probably Indian markets is now looking beyond rate hikes by the Federal Reserve?
I think the Federal Reserve rate hikes, or the kind of pause that they are talking about is more or less factored in the marketplace. In fact, Street is expecting 2 hikes from the US Federal Reserve at the best case, or probably the worst case in terms of the market expectations. But inflation is easing, especially in India. In the US, the core inflation remains sticky, which is a point which the US Federal Reserve is closely watching out for. But I think given the fact that commodity prices have come out, crude oil prices have come off, precious metals have come out, probably the risk is on, and the flows to the emerging market ETF has continued, because of which India is getting some inflows from the FI desk as well.
Well, and with that, let's move on to the stocks on our watch list this afternoon, beginning with MCX. The stock had a good winning streak for almost 6 days in a row. Today, it snapped that. The stock fell by close to about 3%. Some bit of profit taking was expected given the run up in the stock. Now, according to brokers tracking the stock, much of the interest is largely coming in from high net worth individuals in MCX, and one of the reasons for that is now the company will be soon, or rather the boards will be shortly migrating towards the new software platform developed by TCS. Now, there was some delay in the platform being developed, because of which MCX had to continue with the existing vendor, that is 63 Moons, and the terms were quite stiff, which also led to a sharp increase in operating expenses for the March quarter, and the boards barely managed to break even, but now that is passed. Although there seems to be some uncertainty about when the migration will finally happen. The deadline is expected to be June, the end of this month. Now, if that happens, what Street is betting on is that there will be a sharp drop in operating expenses that should give some relief to the margins. Among broking houses tracking the stock, Morgan Stanley still has an underperform rating on the stock. Its price target for MCX is 1,125, and one of the reason why Morgan Stanley is bearish on MCX is that it sees the earnings growth progression to be slightly slow, and that is pretty much evident, Yatin, if you look at where the revenues were in 2012 and where they are now. There's not been much of a change. Right. Even operating margins are not as fat as they used to be back then, which to a large extent the stock price is reflecting that. So, the big question here is, can the stock re-rate?
Absolutely, and they are already doing some mock trading sessions with brokerages. They have enough data right now, Santo, but as you are mentioning, I think by this month they should be able to give a conclusive direction to their new software which has been developed by TCS. So hopefully things become normal at MCX very soon. But the other stock on my radar today is Dalmia Bharat. Jefferies has come out with a buy note on this one with a target of nearly 2,500 rupees, which means that from here on also the brokerage believes that there could be a 10 to 15% upside. Why is Jefferies bullish? Because we have seen a very big fall in the energy cost, especially the thermal coal prices are down, which is good for cement companies, and also there is a buzz in the marketplace that diesel prices also could be cut shortly by the oil marketing companies on government directions in order to ease inflation concerns as well as pass on the benefit of lower crude prices to the Indian public. So let's see if energy prices further come down, there could be some margin expansion. The company is planning to target a capacity of 47 million tons in FY24, which is the current financial year, and in the next 5 to 6 financial years they expect this capacity to treble. So very aggressive expansion plans for Dalmia Bharat, post which brokerages have turned bullish on the counter.
Well, the big play on cement in fact was a sharp drop in operating expense, and that is not exactly played to plan, at least as far as the March quarter is concerned. The other big factor in favor of cement companies was that the pricing was fairly strong, but now as we are headed into the monsoon, but typically the April to June quarter is traditionally a strong quarter for cement companies because there is a lot of pickup in construction activities just before the monsoon. Remains to be seen how market will look at the sector in general. So most companies in the sector have had an indifferent run, but Dalmia somehow has managed to hold ground. So let's see if the trend can sustain. Last bunch of stocks on our watch list this afternoon is from the banking sector. PSU bank stocks were under pressure today, and including some of the private sector names as well. Overall, the sentiment for bank stocks has turned bearish quite rapidly. Now, till about a couple of months back, just before the earnings season, the general view was that bank stocks should continue to outperform. That's because their numbers were expected to be strong. Now, what has changed all of a sudden is the steady increase in deposit rate, and according to CRISIL, net interest margins may have peaked out for the time being, and they are likely to come off by about 20 to 30 basis points for the rest of the year. That's because a lot of deposits will be repriced at higher interest rates over the next few months, and that could put pressure on the net interest margins of banks. There is another reason as well, and that being that corporate India being in a very good position at this point in time. The balance sheets are pretty strong, and in most cases the companies are funding capex requirement through their internal accruals and not so much through bank funds as used to be in the past. So on the positive side, you have some bit of you have less of asset quality risk like was seen in the past, but on the negative side the margins really are growing, and that is something now the market seems to be concerned about.
Clearly, and PSU banks have also run up a lot in the past few trading sessions, and probably there is some bit of consolidation right now in those names. Talking about pharma, and today we had some buying in pharma stocks on the back of weak markets. Obviously, whenever the markets are slightly toppish, there is a bout of buying which comes in FMCG and pharma stocks, because these are typically the defensive counters. Now, if you look at Sun Pharma, Motilal Oswal Financial Services has a buy on this one with a target of 1160, which means that from current market price they expect a 20% kind of a upside, wherein Motilal Oswal believes that there could be some promising growth for the specialty drug portfolio of Sun Pharma. Now, if you look at the generics business also, that has remained stable despite the pricing pressures and demand pressures in the US markets for Sun Pharma. And moving ahead, given the fact that their ANDA pipeline, which is the new drug pipeline, looks good, the specialty segment as per the management guidance also could grow in double digits. That could bring in good earnings growth for Sun Pharma. In fact, Motilal Oswal believes that the company is trading at a attractive valuation of 22 times 1 year forward earnings, which could mean that there could be some further upside to the rally in the shares of Sun Pharma.
One good thing for pharma sector in general is that the pricing pressure in US generics, that appears to be coming off a little bit, and one of the main reasons for that is that US generic drug makers, they are facing a lot of balance sheet problem because of the sharp increase in interest rates. So, already they had high levels of debt, and now because interest rates have also been climbing steadily, that has put them in an awkward position at this point, and they are unable to aggressively price their products as they were doing in the past. And in fact, some of them have already started vacating some of the positions, and which in turn you have Indian companies which have got good balance sheet at this point in time, and they are willing to invest also. So, it is clearly working out to their advantage, and this is what seems to have turned the tide in favor of Indian pharma companies, according to a section of players who are tracking the sector closely.
Absolutely.
And well, with that it's a wrap on this episode of Closing Bell. Thank you for watching.
Please keep tuned in for all your business news and general updates with Moneycontrol and CNBC Awaaz.
And we'll be back with you again at 9 a.m. tomorrow morning.